Nearly 80% of Americans now view fast food, ready, as a luxury. Going to fast food restaurant is now a luxury.
All of it's coming down. It's an affordability crisis.
You're in deep doo-doo. Mortgage rates are doomed to stay above 7% for the foreseeable future. Federal Reserve unlikely to raise rates before September. Housing market analysts expect mortgage rates to remain above 7% for the most of 2024. Fannie Mae predicts the 30-year mortgage rate to reach 7.1 the upcoming quarter, significantly higher than the previous 6.4, while Freddie Mac's baseline scenario includes one rate cut towards the end of the year. Wow, Freddie Mac is now only thinking one, but maintains elevated mortgage rates throughout. Rising inflation caution Fed policies have led to revised forecasts for borrowing costs. Freddie Mac's chief economist, Doug Duncan, noted, we see rates remaining closer to 7% through the end of the year. The market has reacted to discouraging consumer price index reports, complicating the outlook for potential buyers and sellers. High mortgage rates have disincentivized homeowners from selling, as many are locked in rates below 4%.
And this is connected to this morning, Cash Kari, my favorite guy with the Fed, actually, because I think he's pretty balanced, but he's been out there talking. He was on CNBC this morning. He's out of the Fed Bank in Minneapolis. And he basically points out and says, listen, we need to see a lot more positive inflation data before we cut rates this summer. So what does that mean for you and me? What that means for you and me, here's what it means, America. It means that between now and the end of the year, 7 to 6.75%, meaning at the end of the year, 6.6, 6.75. That's what it's going to be about the end of the year. And at the end of next year, looking at like 6. So when they say 7% for the foreseeable future, it's probably 7% through third quarter and maybe get a little cut. And then it's not going to be dramatic, Pat. It's going to be like 6.75. That's where it's going. And so if you're going to buy a house and then you're thinking you're going to refi 6 months later, no, you'll probably refi 2 years later. So that's what I think people should look at when you're making your personal plan. If you can afford that house and you can afford the payment and you can afford 6.75, that's what you're going to have toward the end of this year. And it's probably going to be 2 years before you get cuts to a point where you can make a refi that
2 years. 2 years.
Yeah.
So you're taking 2026.
Correct, because the end of next year, they're only looking at 6% mortgages. And this is all the people that are out there.
Say Trump gets elected. What do you think is the likelihood of him firing Powell and replacing him?
Powell's been such a lightning rod. Remember, he's elected to a term. So would Trump invoke authority and then get him not elected to his next term? I think Trump's going to look for a new Fed leader. Yes. So coming into Trump's midterm election, he would have an opportunity to change the Fed chair.
So he's staying till 2026. Okay. So when you look at this, then you going back and you saying the fact that it's probably going to stay around the 6s, even in 2025, seems very reasonable.
So if you got a 6.75 or a 7 this year, 24, 2 years from now, probably a 5.5, 5 3/4, and you can refi it.
5.5. You're not thinking we're seeing 4s in a while.
No.
Mm-hmm. Okay, I agree. I don't
maybe
think
a 5 for really good credit, and you buy half a point. That kind of a deal.
For sure, but 4.5, that's not coming anytime soon. Those are the days of what we had in the past. Yeah, I agree with you. But now watch this. Here's the crazy part: housing prices hits another record high as affordability crisis deepens. So rates are remaining high; they're not dropping. But affordability crisis deepens because prices are not going down. Housing prices hits a new record with the median U.S. households hits $387,600, a 4% increase from the previous year, according to Redfin, despite a slight dip in mortgage rate, 7.02. Monthly mortgage payment remains as high as $28.54. That's the average mortgage payment. Elevated mortgage rates and high home prices have been keeping some buyers on the sideline this spring. You think that they've been sitting on the sidelines? The affordability crisis is driven by years of underbuilding, a rise in mortgage rates, and expensive construction materials. This has created a golden handcuff effect where homeowners with low mortgage rates from the pandemic rate, reluctant to sell, further limiting supply. Move-up buyers feel stuck because they're ready for their next house, but it just doesn't make financial sense to sell with the current interest rates. He's right.
Like with anything, it depends on who you are in the situation. Because the story here right below that, the baby boomers are approaching peak burden of the economy. So here's what I would tell you. If you're a young person looking to buy a house, it's not your turn, buddy. What's the reason? Supply and demand. The story right here basically said housing prices hit another record high as affordability crisis deepens. Listen, when you're going to buy something, you have to ask yourself, is it cheap or is it expensive? And that's how you can kind of weigh your options. It is incredibly expensive to buy a house right now. I know a lot of people, we've been sort of given the propaganda of like, if you're renting, you're throwing away money. If you're renting, you're throwing away money. But it all depends on where you're at in life. If you're young and you're just starting out your career and maybe you have the opportunity to live with a buddy, live with a roommate, live with a girlfriend, whatever it is, renting is fine, and just pump all your money into the market. Now, if you're a baby boomer, typically baby boomers, when they approach 65, when I started in the financial world, I heard a stat about baby boomers that starting in 2010, I believe, for the next 20 years, 10,000 baby boomers will turn 65 every single day. Boom, 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 boom. Every single day. Birthday, blowing out 65 candles. So here's the deal. Usually, typically, as they retire, they downsize. Their kids are out of the house. They're like, all right, forget it. We're moving to Florida. The reality is at this point, since COVID and since these interest rates, they're not going anywhere. They're like, why would I sell my house that has a 2% mortgage, 3% mortgage, 4% interest rate to go spend 7% on a mortgage? It doesn't make any sense. So they're staying put. So supply and demand is limited. So if you're the Vinny of the world or a younger person in the world, you're like, I'm looking for a house. Too bad. Now, what I would tell the mortgage brokers out there and the realtors out of the world, here's a little advice to you guys. Here are 3 words that made me a lot of money. When you're calling on people and you're calling on potential clients, here are 3 words you could use to pique someone's interest. Things have changed. Because when things change, people feel motivated to do something. Right now, what's happening in the economy with the mortgage rates and everything that's going on, it's status quo. So if you're out there being like, how can I make some money? How can I basically deliver a different message to the consumer, to my client? Let them know that things have changed, whatever it is. And even if it's that they have to refinance in a few years, that's something that can change.
But for me, like the average person, Tom, is listening, home ownership, dream, investment. Should I get into one? Should I not get into one? The slow play, history of rate of return in real estate.
I think that the stock market is double whatever real estate is.
Okay, but
so I think real estate is around 5%, and I think the stock market is around 10%.
Watch this. In the 30s, real estate dropped 1.2, stock down. So that's obviously Great Depression, 0.9, that decade.
Yep.
Cash 1, bonds 4, gold 5.3, inflation minus 2%. So it's the opposite. 40s, stock 8.5. Real estate 8.1, so they're about the same. Inflation 5.4. 50s, stock 19.5%. Vinny, this is good for you to see. Real estate 3, inflation 2.2. The difference between real estate and stock, look at that. 16.5% above real estate. Gold's only 1%. 60s, 7.7. Real estate 2.2. So 5.5 above. Inflation 2.5. 70 stocks 5.9. Real estate beats. And that's because of boomers are becoming in their mid-20s, 1946. Yeah, that's cause of boomers are buying houses now. So 8.7, 5.9%. Look at gold. That's when Nixon, we went off the gold standard, so 29%. Inflation 7.4. 80 stock market 17.3. Real estate 5.9. So the difference is what? 12%. Inflation 5.1. 90s 18% to 2.7 in real estate. Yep. 2.9. 2000 stock drops. Okay, this is the 2008 debacle. So -1. Real estate 4%, and then inflation 2.6. 2010 13.4 to 3.8. 2020s 11.9 to 10.2, which is about the same. But if you look at this is what I want you to think about. Real estate's only had a -1% decade once. Okay. Stocks has had it twice, but look what it is. It's not anything crazy. It's 0.9 and it's 1%. So you're not losing money in the stock market over a decade. But look how many double-digit real estate has versus the stock market. Stock market has 1, 2, 3, 4, 5 double-digit. Real estate only has 1. So why am I showing you this? Reason why I'm showing you this, Tom, right before we got started with the podcast, you said with the reports being said that the S&P is about to get to what?
Yeah, UBS came out and said that they're going to put a target forecast at 5,600. They think that the forces on the stock market are good, even though the consumer can feel bad.
So while real estate is not showing any kind of optimism on what could happen with it, stock market's about to go to 5,600. So if the stock market's about to hit 5,600, where's S&P at right now? When I say stock market, I mean S&P. Go show up what S&P's at 5,000 right now?
5,300.
Okay. So it's going to go up another 300 points. 300 points on 5,000, 5,300 is what? 7%, let's just say 6%, 5.8% is what it is. So if we go to real estate, the difference with real estate, where the real estate investor is going to make the argument, is the following. in order to buy stocks, I'm putting $100,000 of my money in there where I'm competing on, if the market does 10%, I make 10% on what? $100,000, which is what? $10,000. But if I use $100,000 to buy a property, I'm buying how big of a property? A $500,000 house, let's just say, or condo, right?
Yeah.
So 100,000, I'm pretty much margin, not necessarily, but I'm using debt. So my 100,000 on a $500,000 house, now I'm paying a loan on $400,000. Let's just say I'm paying $3,500 a month, $3,000, $3,500 a month, whatever the number is, right? So watch this. If that $500,000 property in 2 years goes to 550, okay, now I got what? 50,000. So 50,000 on the original 100,000 is what? 50%. But that 50,000, when you choose to sell, you're going to have to pay what? 4% commissions, give or take, on $600,000. So $600,000, 4% commission is what? $24,000. So your 50,000, 24 is gone for what? Fees.
Yep.
You net 26 over 2 years. So it's really 13% per year, not even considering the upkeep that you have, right?
Of course.
So that's the argument real estate's going to make versus the stock market. But at the same time, the problem with some people that are making that are just waiting for real estate, they're not getting involved in what's going on with the market today. They're missing out on NVIDIA. They're missing out on a bunch of AI stocks. They're missing out on not being a small cap, mid cap. The other day, I'm at the Goldman Sachs event. Very interesting, Tom. Very interesting. The family, everybody that has sold a bit, was 60 families there. Minimum net worth to be in that room was $1 billion. Okay. And the high was $30 billion. Incredible things to learn. One of the guys gets up there and says the craziest thing. They said, who's your, how do you feel about the future of the stock market? He says, oh, I fully believe the market's going to do very well. He says, based on whose analysis? He says, because the number one analyst in my life for the last 45 years is my grandmother. He says, excuse me? He says, yeah, my grandmother. Why? My grandmother's 99 years old, and she still tells her stockbroker and her financial advisor, I only want to buy growth stocks.
Wow.
Think about
She's in
that.
her 90s.
Did you understand, Tom, what happened right there? She's 99 years old. How many more years you got left to live? 1, 2, 3, 4, any day?
She should be in
right?
bonds.
Could be gone right now,
Should
for all
be
we
in
know.
bonds
Yeah.
and cash.
That's crazy.
She's saying, put me in stocks, buddy, because I believe in America.
Yeah.
Wow.
So that is the part that I think sometimes, this is the part where diversification makes sense, to have a little bit of stocks, a little bit of gold. If you're comfortable, a little bit of crypto, a little bit of real estate. That's the part some people are missing out on. But this chart shows it all. Go ahead, Adam.
Nah, here's your metaphor. People speak, but numbers yell. Say it.
Words talk, numbers scream.
There it is. Look, what I see here is that it takes a literal worldwide pandemic for real estate to actually compete with the stock market. How could you say such a thing? Just look at the numbers. They've had one time during the pandemic that they've been above double digits, real estate. Stock market 1, 2, 3, 4, almost 5 times since 1930s. The average stock market return is what? 10% year over year. Sometimes it's closer to 20%.
Yeah.
But that doesn't mean that real estate is bad. It's just not the rate of return that you can get from the stock market. Now, why do people invest in real estate? Number one, it's tangible. It's easy to understand. It's a lifestyle choice. You've got kids, you got school districts, you've got neighborhood, you got safety. It's something that you can touch and hold and your family can be there, feel safe. It's like a big warm hug around your family. I get that. But if you're just looking for sheer numbers and sheer return, it's not even close. The last thing here is 50% of the people, 2/3 of Americans buy houses, 1/3 rent. Only 50% invest in the stock market, 50% don't. What's the difference here? I would argue that it's just way harder to understand the stock market. It's bulls, it's bears, it's bells, it's red, it's green, it's up, it's down. It's which way is it? It's like the S&P, it's the Dow, it's the Nasdaq. People just don't understand, but people understand real estate. Money talks, bullshit walks. It's clear stock market is better than real estate.